Hello everyone. In this video, I will show you some technical studies on the divergence of the MACD indicator using price. I am sure that the strategy model we will produce using this technique will make you very profitable trades, because this method is one of the systems that has been used for many years and even professional traders give full marks to. First, we will fully reinforce our strategy, and then we will revise it without breaking the foundation of this strategy. Let's first adjust the indicator settings. Of course, don't forget to subscribe and hit the like button. The basis of our trading strategy will be the price indicator divergence using the MACD histogram. We will use Bollinger bands with 2 and 3 deviation values to help us identify potential places where the price may reverse. MACD moving average convergence divergence is a momentum indicator that tracks the intersection and divergence of moving averages. MACD is calculated as the difference between two moving averages of different time frames, and it creates a line as a result. Additionally, the MACD signal line, which is the moving average of the MACD line, is also included. The MACD histogram represents the difference between the MACD line and the MACD signal line. Bollinger bands, on the other hand, are an indicator used to track price movements. Bollinger bands consist of an upper and a lower band located above and below the moving averages. These bands are drawn with a certain standard deviation value around the moving average. Bollinger bands are based on the assumption that prices will generally stay within these bands, and when prices go outside of the bands, they may return. Therefore, Bollinger bands are used to determine price reversal points and to detect trend changes. According to the first rule of our trading, the price must enter between the two Bollinger bands. Ideally, the price should close within these two lines, but if the candlestick leaves a wick between the two lines, it is also considered valid. Afterwards, the price should return to the wider range and visit the area between the two Bollinger bands once again. When this happens, if there is a movement in the opposite direction in the MACD indicator below, it is called a price indicator divergence. As you can see, the short position trade here was successful with a 1-to-2 risk-reward ratio. Immediately after this, a different trading opportunity arose with the price action in this area. And this long position trade was also successful with a 1-to-2 ratio. And again, we see a divergence. Another trading opportunity has appeared. Yes! Now, to strengthen our trading strategy a little more, let's make a small addition. All of our rules remain valid, but after finding a divergence, if we are going to make a long trade, we will expect to see a green bar in the MACD histogram. As you can see, there is a negative divergence here, indicating a potential short position area. Additionally, we see a red bar in the histogram, and we open the trade based on the closing level of the candlestick that corresponds to this bar. The duration of the trade was quite long, but we still reached our target. I believe that you had easily understood the rules of our trading strategy. If you have any questions, please write them in the comment section. Now let's quickly look at a few examples. Friends, now I will show you a tested indicator that works perfectly with our powerful strategy, and I will finish the video without extending it too much. I don't like these types of buy-sell based indicators, but this indicator really works great. Let's set it up now and integrate it on top of our current strategy.